Thanos Papasavvas is the founder and CIO at ABP Invest. You don't game, do you?
Well, I just got an Atari from my sister as a birthday present.
Whoa. We're not back in 1986, my friend.
Totally. Atari.
The only one I ever had was a Sega Mega Drive, because all the lads were buying. We were all on the trading floor in life. Everyone was buying them back 1992. Yeah. I played it once. I hated it.
I had some Donkey Kong thing.
Oh, yeah, I like that.
Oh, that's nice.
Yeah.
What did you do with your Atari? Just like
I just got it. Yeah, a couple of netball and basketball and dodgem. I just got it a few days ago.
That's so retro.
So I'm looking forward to the weekend.
It's the only retro thing about you, because the rest of you is very forward-looking. So talking of being forward-looking, what's going on? I mean, look, I'll start off on the big question and we'll move on, because even I am kind of over chatting about Trump a little bit. I think the equity market is maybe doing the right thing. It's ignoring it until it's a real threat.
Yeah, I think if we look at the underlying fundamentals in Europe and the UK, they're favourable, especially the European fundamentals. There's been a lot of doom and gloom on the economic environment. The European underlying economy has been in a recovery, and as far as our data is concerned, it's moving into sort of an expansion. In terms of the US equity market, what's holding it down is valuations. So the fundamentals are very supportive. The politics is supportive, the geopolitics is supportive, market price behavior, but without sort of heavy valuation level, we're not that attractive. And the key there for us, as we discussed before, is that we think the Fed is going to be raising rates in September. So with that, we're slightly more cautious on the US market, but continue to prefer Europe, UK, and China.
Yeah, but okay, just on that US valuation, we spent a lot of time talking about it, so I don't want to go too long. But if you're talking about 20-ish times the broader S&P forward PE, and which is inflated historically by those very big tech names, there are those out there, the Cathie Woods of this world, and I actually understand where they're coming from. I don't have to agree, but I understand where they're coming from, that we're valuing it on the wrong level. We're looking 1 year forward PE, and actually companies that have got exponential growth coming over coming years because of these amazing structural changes in society as well. So valuing a market historically on a forward PE, they are saying that's just not the way to. You need to look at it on a multi-year basis and look at other things as well. You have sympathy with that view, or you think we are overvalued?
I think it is overvalued, and it's not just the large caps, it's even the small caps. We find the small caps overvalued as well. So if you like, in terms of our scorecard, we have a -3 out of -3 in both large caps and small caps on the US equity. We're not negative because the economy is underlying supportive and the underlying fundamental strength is there. But we are neutral. We prefer to utilize that risk unit elsewhere.
Thanos, just buy something. That seems to be what investors are doing, whether it's a buy the dip in the United States when the market comes off, whether it's underloved parts of the international equities sphere at this point. That, of course, has been Europe until recently, and also across in the Asian markets. It feels as though investors are using every sell-off, every underpriced market as they see it to just get back in. Does that FOMO worry you?
It does in a way. For example, let's take Japan as an example. We were positive Japan from 2020 until late 2024. But more recently, again, we turned neutral Japan. Why? Because we think that the underlying inflationary pressures are going to get a little bit out of hand. The BOJ is behind the curve, the market's behind the curve, and we could be seeing more rate hikes coming out of Japan than what the BOJ and the markets expect. So that would or could put a dampener into the Nikkei, and it's no longer as cheap as it was. So I agree with that sentiment, and I still believe that investors are not seeing China, in my view, for what it is. The underlying attractive valuations there, and the underlying support to ensure that economic growth and social cohesion succeeds.
It's fascinating you put those two pieces of the puzzle together, because I did wonder whether all those fund managers who've been so overweight and so interested in Japan should be pivoting some of that investment portfolio towards China. China has been uninvestable for years, according to a lot of investors. Now, what we've seen was bull market in technology. Do you chase it? Are we only early days when we talk about 20% up?
I think it's early days in terms of China. There's as you mentioned, I was interviewing. I was having discussions with a number of asset management CEOs, and approximately a third of them basically saw that China was uninvestable. That was about 5 months ago. And I do see, as sentiment starts to change, and part of that will be price-driven, we could potentially see that investors are very much underweight that exposure. And it is the second largest.
But how do you play? I was looking at the Hong Kong market saying that the high point for 5 years was, 30,000 points. And at 22,579, we're well off the 30,000 high watermark. Can we get all the way back on the Hong Kong market? Is that the way to play the trade?
I think China is not going to go back to what it was previously. Xi Jinping has changed that structure. I'm not of the view that we're going to go back to the 8% growth, not at all, because the underlying philosophy that Xi Jinping is different from where it was. However, I do believe that we are going to see a gradual structural uptick in the underlying economic factors, and China will offer diversification in a well-diversified portfolio because of its economic cycle being different, interest rate cycle being different, and the attractive valuation. So it's not like it's going to rally like it was, but it will provide more positive returns than what it has been.
Congratulations on your column in the FT. It kind of echoes what you've said to Karen and I previously. Yeah. And I know it was a couple of weeks ago, but it was very interesting and I think thought-provoking for those who think we're in a downward cycle on interest rates as well. Your basic premise was Fed rate rises are on the horizon despite forecasts. And so I just want to kind of actually flip that over to Europe as well, because Europe would be on a cutting cycle at the time where the US is holding stroke hiking as well. So the relative rate differential will pick up aggressively as well. How has that priced European equities then, given that?
Well, I believe that the ECB does have a little bit more room to cut because the inflationary pressures within Europe are more contained than those in the US. So generally, inflation will not go back down to the 0 to 2% level, but within Europe, it is at sort of a Goldilocks 2.5%. So inflationary pressures are a little bit off. So I do believe that the ECB will continue cutting rates, but it may not do as much as the markets expect. So the interest rate differentials will be adjusted, but still attractive for European equities.
A lot of raised eyebrows in Europe about Trump and Pete Hegseth's comments in the last 24 hours about potentially trying to end the Russo-Ukraine war. We'll park those concerns aside for now. If the Russo-Ukraine war were to end in the next 3 to 6 months, there is a school of thought that the Russian energy prices, or Russian energy could well find its way back to the European market, that energy prices could fall. Is that another catalyst that people have been very concerned about, certainly for the industrial side of Europe as well, that actually could act as a really positive catalyst, i.e. the natural gas price differential that Europe pays compared with certainly the States and other parts of the world, that could narrow somewhat and act as a forward catalyst for the European economy? I
think if you look at the probability curve with the Russia-Ukraine, I see significantly higher right-tail risk events rather than a left-tail risk event. In fact, across the geopolitical, whether it's Russia, Ukraine, China, Taiwan, or the Middle East, we don't see any left-tail risk events.
Right.
We think the risk is contained. So yes, any underlying agreements which are taking place will be helpful to the Europeans. However, I don't see sanctions being eased too far, partly also because the Chinese want a stable Russia, but not a weak Russia.
Thanos, when it comes to positioning in Europe, there's no doubt we've finally found some momentum here. I was talking to UBS yesterday. They've now switched to an overweight on European stocks, and that took me by surprise because a lot of investors are still somewhat coy around the European exposure versus others. Do you think there's further room to run if we get a repositioning argument that's broader for fund managers?
Our process is still quite positive, quite strong. The valuations are not as cheap as they were. So from a valuation point of view, the UK valuations are more attractive than the European valuations.
Even at a record high?
Even sort of a valuation to valuation level, yes. I think the UK is better than Europe, but the European valuation is not as cheap as they were a couple of years ago. But we are still positive for the European equities.
Thanos, thank you very much for joining us. Thanos Papasavvas with us, founder and CIO at ABP Invest.